So shall we start? Okay, it's about 7. So everybody is very welcome to have Professor Thorsten Beck's seminar on our EconFin seminar session. And as many of you would know, Professor Beck is a very well-known banking expert, very well-known for globally and also in the Europe. And he has been also in the field of stability board, scenario analysis, and many aspects of banking. He is also watching the policy as well. So we also would like to thank our sponsor, Turkish Banking Association, for making this happen. In addition, Professor Erzan, who has also been a big help on the organization part. So we have 1 hour for Professor Beck's talk, and then we have 15 minutes for ground for questions. And Professor Beck can share his slides, and then he can start. Again, we thank you again, Professor Beck, for accepting our offer. And then floor or whatever is yours. I mean, you cannot say anything about here, but so please.
The screen, yes. Okay, well, thank you very much, Barak, and thank you very much for this very kind invitation. I titled my talk Recovery of Banking After COVID-19. I will talk about quite a lot of different topics, but maybe as a way of introduction, let me start with these 2 graphs here. Before we talk about banking, before we talk about finance, I think we just have to again see this on the background of the more general crisis that most countries and most people around the globe are currently living through. So on the bottom you see the number of I think these are cases. Yes, the number of cases across different regions and how they have developed. As you can see, there is actually also changes over time. For example, Southeast Asia was fairly big at the beginning. In August, September has come down. Europe has been increasing almost constantly, but also the Americas have recently almost exploded again in terms of the number of cases. Now, this pandemic, plus the public health policies triggered by it, have of course also had a very negative effect on the economy as such. Here I'm just showing you the numbers for the data for manufacturing. You can get, of course, even worse pictures when you look at, for example, tourism, travel, or retail. Although retail is probably a little bit less. Again, you can see a downturn pretty much everywhere, although there is some variation also in timing. China early on, and then basically recovery. India very deep. Japan kind of more a slower decline, and also again recovery. In other countries, it's actually kind of less of a downturn, just in Russia, for example. But so this is just to show that we do have a devastating crisis. A devastating crisis that, unlike the previous global crisis in 2008-9, did not start in the financial sector. But the financial sector will also be affected by it, as most sectors in the economy. But at the same time, the financial sector is also critical. One could argue both for the survival, for the kind of the crisis mitigation policies, but then ultimately also for recovery. Or put it differently, if the financial sector is not dealt with correctly during the crisis, it might actually be the trigger for a next crisis. A little bit similar as what we saw in the euro area after the global financial crisis with the euro debt crisis. Now, when you look at the initial reactions, and here I'm referring mostly, not exclusively, but mostly to Europe, the financial sector stands much better now than it did in 2008-9. The capital buffers are higher now than they were during the global financial crisis due to the regulatory reform. There's much more data available to monitor the situation and to inform and guide policymakers. and there's also experience with crisis management. So the global financial crisis came at the end of a very long 20-year period of moderation. This time around, the previous crises are still in everybody's mind, and so it was much, the preparation was much better. Now, at least on a theoretical level, I don't think so really in practice. The framework for international cooperation is as good, if not better. In Europe, it's definitely better. Globally, it might be better, but it's not really being used. Again, what I see as the biggest risk right now, again, from the financial viewpoint, from the banking sector's viewpoint, is that the economic crisis that we're currently living through, and that we hopefully will be able to get out of with the vaccine next year, might turn into a financial crisis. And that's a topic I'm going to come back to actually at the end. So I'm going to touch upon 4 themes. The first 2 are actual short papers that I've written during the last couple of months. The third is then more discussion of what kind of policy reactions have been taken over the last 10 months, and then and also some of the debates where I've been also involved in. And then finally, kind of touching on both maybe optimistic, but also maybe a kind of pessimistic view, depending on how you want to look at it, looking forward to what expects us in 2021. So a first paper I want to briefly talk about is on the US. And the US is an interesting example. I mean, we can draw implications from what we see in the US for other countries, but the US is an interesting example because both the spread of the virus and the public health measure, the lockdown measures, as we might want to call them, or what some people refer to as non-pharmaceutical interventions, have varied a lot, both over time and also regionally. So if you look at the left-hand side, these are COVID-19 related deaths. As you can see there, this is for the first quarter. We had mainly at the 2 coasts, the East and the West Coast. Then it spread to the Midwest, also the Southwest. And then ultimately in the 3rd quarter, it moved especially to the South. And if you look at the right-hand side of this graph, you see that similarly, initially the lockdown measures were mostly implemented in the coastal areas, even stronger so in the 2nd quarter, with fewer restrictions during the 3rd quarter. So there's clear variation here. And of course, as I'm going to mention in a moment, there's also variation, therefore, on banks' balance sheet, to which extent they actually have been exposed to this crisis. And that's actually what I'm showing you here is, again, this variation allows us to kind of compute or construct a measure of bank exposure to COVID-19 and lockdown policies. So if you use for each bank, the branch deposit share, so how much deposits did they take through each of their branches, as kind of weights across all of the counties. So we have the county level data for COVID-19 and lockdown policies. We can kind of compute a bank level measure also on the quarterly level or on the aggregate level to how much each bank was exposed to the COVID-19 pandemic, but also to the economic implications, repercussions of the lockdown policies. To give you an example here, in this graph, in this little map here, I have 2 banks. I have Citibank, as everybody knows, headquarters in New York, and lots of branches, especially on the coasts again, but also in Chicago, for example. So very exposed to the COVID-19 crisis, but also very exposed to the lockdown measures. On the other hand, you have a bank called Science Bank Corporation from Utah. So you can see the blue spots are very much concentrated in the state of Utah. And in general, the branches are more concentrated in an area which were less affected, at least initially, by the COVID-19 crisis, pandemic, and by the lockdown measures. So this is a bank that was less affected. So we can do this for each of the banks. And so we have a large sample of banks and can kind of see is, what I'm going to look at it in a moment, is going to see whether this had made a difference for both bank health, but also for bank reaction in terms of lending and loan conditionality to the pandemic. So, but first of all, actually, before I go there, I look actually at the county level at COVID-19 and the lockdown measures to see whether the effect was actually stronger in counties that were more affected by the pandemic and by the lockdown measures. So the red line here is in counties with non-zero COVID deaths in a given month, and counties above the median for the subsample. Whereas the black line are counties for which there, in a given month, there were no COVID deaths reported. And as you can see, while unemployment went up in both groups, it went up significantly more. I think this is like at least 2.5 percentage points more in the counties that were more affected by the COVID-19 pandemic. By the way, if I use infections instead of COVID-19 deaths, I get very similar results. So that doesn't really matter. Now, if I look on the right-hand side, this is the exposure to an index of lockdown measures. So higher index means more stringent lockdown policies. And again, the counties, actually in this case, it's states that implemented higher economic, more stringent lockdown policies, stay-home policies, were also more affected and saw a higher increase in unemployment. So this is more a general kind of approach, more kind of economic policy. It's not really directly talking about banks. And by the way, these two phenomena explain independently the rise in unemployment. So it was both the pandemic and it were the lockdown policies that both had a negative effect on, or had an exacerbating effect on unemployment. Now, if I look at bank health, so here now I go to this measure of bank exposure to COVID-19 or to lockdown policies that I discussed earlier. And as you can see, loan loss provisions went up for banks that were more exposed to COVID-19 and were more exposed to the lockdown measures. With a little bit of a delay in the case of non-performing loans. Sorry, this is just COVID-19, sorry, not the NPIs. But in both cases, you can see this here. Of course, NPLs are always a little bit backward looking. That's why there's a little bit of a delay here. Now, if I look at lending, what you can see here is an increase in the overall lending volume of the US banking sector, which by the way is also matched by, as I'm going to show you later, for the euro area, in the second quarter of 2020, and in a somewhat smaller but still increase in the third quarter of 2020. But there is no difference in the overall increase in lending, dependent on whether a bank was more or less exposed to the COVID-19 crisis. If you look at the three subcategories that we have small business loans, we have commercial industrial loan volume, which actually includes also some of the small business, and we have household loan volumes. You can see that this non-result, so that loans increased similarly across both groups of banks, is driven by the C&I loans and by the household loans. Household loans barely increased at all, a big increase in business loans. And as I mentioned, if you look at small business loans, on the other hand, you can see that banks more exposed to the COVID-19 crisis also increased their small business loans more strongly. Now, how can I interpret this? And actually here the increase is even bigger than for the kind of large enterprise loans. One is, of course, that small businesses go for local lenders, and therefore you would see also a stronger increase for banks in small business loans that are more exposed to areas where small businesses were more negatively exposed to the crisis. And of course, on the other hand, that the large enterprises, so reflected here in the C&I loans, don't really have to go to local banks. Even if you're located in Kansas, you can still, or in Missouri, you can still get your loans from Citibank, for example, in New York. Now, another reason actually is that, and this is from a different paper, by Virala Shaya and Sasha Steffen, that there might also be a variation across different firm groups, firm types, where the highly rated firms initially could draw down their credit lines, but then actually could go to the public markets and issue bond and equity. Whereas less lower rated firms, triple B, for example, or non-investment or unrated firms, they really had to raise their cash they could raise their cash only through credit line drawdowns or bank loans. So they had no access to the public capital markets and had to go to financial system. So one thing we can already conclude, and that's again not just out of my study, out of many studies, is that the increase in lending has been to a large extent due to increase in loan demand and to a large extent due to the drawdown of credit lines by firms. And again, we see something similar in the euro area. Now, let me give you a final graph here. This is for loan conditionality. What I'm looking here at is a syndicated lending in the US, a very similar approach. Just here, I'm looking at interest rates or loan spreads and maturity. And as you can see that banks that were more exposed to the COVID-19 crisis also increased their interest rates to their borrower more. So they had a higher risk premium compared to other banks. And of course, that's against the backdrop of a lowering in the monetary policy rate, the federal funds rate in the first quarter of 2020. At the same time, maturity dropped actually quite a lot. Again, more for the banks that were also more exposed to the COVID-19 crisis. So again, while there was an increase in lending, driven partly by or to a large extent by the higher loan volume, there was a tightening of loan conditionality, as we can see here from the syndicated loan market. Again, this is for the US. I wouldn't be surprised if, at least for many other advanced countries, you would see a very similar results. It might be different from emerging countries. What I'm actually now going to turn to is a second paper I want to briefly talk about, which is now specifically on emerging markets, but it's also on firms. Now, this is a very different data source and actually very different approach, as you can see in a moment. This is with a former PhD student of mine and a current PhD student. Now, this the way we got these data, we got these survey data, is actually that my PhD student has spent over this 10-month period, a month in each country to collect data. So in his main job, he's a portfolio manager of a Finnish-based emerging market fund. And he undertook private one-to-one meetings with the CEOs, where he could get meetings, of almost 1,500 firms across countries. And one of, as you can see, actually across 3 different continents, Bangladesh, Indonesia, Malaysia, Pakistan, Philippines, Saudi Arabia, South Africa, Thailand, Turkey, and Vietnam. So quite an impressive set of countries and quite a lot of firms he actually interviewed with. Now, once he, of course, in March, he had to stop his travel plans. But as a reaction to the crisis, we sent out a survey to these firms that he met with questions on how they have reacted and how they have dealt with the COVID-19 crisis. We ultimately got 488 responses. And actually, later on, we sent a second survey where we still got a very good response, 415. We've now sent out a third wave, and I don't have the results yet, but that's something for future research. So with these questions, and again, this is very different, of course, from the banking level data, because these are survey questions where entrepreneurs or CEOs are being asked, of large firms are being asked to provide responses. Just to remind you again, these are large, the listed companies with more than $250,000 US dollars of average daily trading volume. So these are the largest firms, but of course they also make a big chunk of the respective economy. So these are not the small enterprises with all of their separate problems. These are large enterprises, but of course even they were affected by the crisis. So the question we ask in this paper, in this study, is how many firms were negatively affected, and what was their reaction, and ultimately what was the stock exchange reaction to their policy reaction, which is of course also interesting to see how the stock market actually values some of these reactions. So what we found in the first instance, and it actually hasn't changed much, almost 3/4 of the firms were hit negatively by the crisis. Very few, though, actually expected to breach the covenants on their loans or expect to require additional capital. That was a bit surprising. These numbers went up a little bit during the second and the third round. Now, the reaction was that many of them reduced investment spending. They did not go for layoffs, although they did make changes, we assume negative changes to executive compensation. So their approach was really protect their workforce, cut back on investment. Because if you can think about, especially in emerging markets, you would also be able to cut back on the workforce and maintain your investment. That's not what it did. Cut investment, maintain the workforce. And there was also, and I'm going to give you some examples in a moment, there was a very, what you can call, stakeholder-centric approach. Almost everybody took some measures to protect business partners, suppliers, stakeholders in general, the community. 46% continued paying their employees when business was disrupted. 39% provided financial flexibility to business partners, and 83% made donations. So quite a impressive result. By the way, I'm going to give you an example in just a moment. So it's not just kind of like firms just showing off saying, yes, we did a lot of good things, but they actually had to give examples of what they did. The good news is also that the financial markets, the stock markets, did not punish this stakeholder-centric approach. Now, let me give you some of the findings. Yes. So this is across the 10 countries. So again, I mentioned 72% of the firms said they were negatively affected. A few firms are positively affected. Again, this might be in certain sectors where they could benefit. I mean, you can see on the right-hand side, this is 10 sectors. Some of the firms in the communication and the consumer goods sectors actually benefited. But again, the vast majority of firms reported a negative effect of the pandemic. Although again, there's some variation across countries. 57% of firms in Indonesia reported a negative effect, but almost 90% in Bangladesh and in the Philippines. You can see here Turkey with 68%, which I think, if I understand my student correctly, is due to the fact that also Turkey did the lockdown very late compared to some of these other countries. As you can see again on the right-hand side, lots of variation across sectors. The consumer sector is actually been most negatively affected, but also, of course, the real estate sector and the industrials. Now, as I mentioned earlier, most firms have reduced their investment spending. Again, lots of variation across countries. Maybe in some countries, let's say in Pakistan, for example, there were not many investment spending plans in the first place. But you can again see also this variation across different sectors. Layoffs, again, few firms have plans to make any layoffs. This increased a little bit later on, also during the last survey round that we did in September, October, for which I don't have the data here. But still, most of the firms really, at least initially, did not fire people. And here, this is, as you can see, very tall columns here, tall pillars, lots of measures to support the business community and the community at large in terms of giving donations, taking in general measures to protect the stakeholders, showing flexibility, and continue to pay employees and vendors even if the service was disrupted. So again, variation across countries, but in general, the majority of firms actually went for this stakeholder approach, which you could argue is kind of consistent. What I've learned over the last 20 years of working on emerging markets is that relationships in the broader community, in the market, are still very important. It's not all about contracts. It's all about the relationships that you have built up over time and that you would like to maintain even during a shock and a crisis like this one. Okay, so what we find, and we do some more analysis. I'm not going to bother you with any tables. I'm just going to give you some of the additional results that we did. So we have, of course, lots of data on these firms because these are all listed firms. We see that, not surprisingly, financially more vulnerable firms see themselves more affected, and they reacted more strongly to the pandemic, for example, by reducing their investment or by trying to raise more capital. Larger firms reacted more proactively to the threat of the pandemic by cutting their spending or by changing their work mode, which again is not surprising. Larger firms are in a better position to do so. Firms that are more negatively affected by the pandemic, or they report to be more negatively affected, they're also more likely to have reduced their investment, executive compensation, and the benefits. But at the same time, they're also more likely to continue paying their employees and service providers. So they kind of can see this two-pronged approach. On the other hand, yes, cut investment, executive compensation, and benefits, but at the same time support the community as such, because ultimately you might have to rely on them in later days. Obviously, all of these results are pure correlations. They don't imply any causality. That's I just want to stress this, but still I think they give us some very interesting insights. I want to just give you here this, I mentioned this earlier, I promised you some examples of how firms shifted their operation. A brassiere company in Thailand started making face masks. Similarly, a Indonesian lifestyle retailer went to face mask and PPE production. There is this self-storage asset owner in South Africa that made their properties available free of charge for storage of COVID-related supplies. You can see at the bottom here, the Minimos taxi financing business provided loan payment relief. So you can see there's lots of specific actions that the firms reported to us through the survey in terms of how they reached out to their community and how they kind of protected their suppliers, their business partners. Final question that we ask in this paper is, how did the stock market react to the firm's suffering effect of the pandemic, but also their policy reactions? So we assume, again, given that these are listed firms, excuse me, the survey responses are not private, really private information. We assume that most shareholders would have similar information as we do after having received the survey. What we find is that we find a negative reaction of the stock market to firms that have to raise capital, cut investment, and lay off employees. But this reaction also continues actually after we received the first survey responses. So it's not like an immediate reaction during the first 2 months, but actually even after our second wave, there is still, between the first and the second survey round, we still find a negative reaction of the stock market. So it seems to be that the stock markets are not really completely efficient in the sense of pricing in immediately all of the negative effects of the pandemic. Maybe more importantly, in this context is that we find this positive correlation between stock prices and stakeholder-centric responses by firms. So firms that were more likely that we continued paying their business partners, their employees, that made donation, they actually saw a relatively stronger, relatively positive effect on their stock returns. Again, relative to the respective market. Which again shows us that the stock markets does actually also value these relationships. In summary, and again, this is kind of the I guess the stock taking in September, I would say. So I'm not sure whether all of this still holds. Certainly no corporate panic. Firms, companies make stakeholder-centric responses for now, and the financial markets do not punish them for that. So this is the kind of two studies I wanted to briefly report on. The first one on the US banking sector, then the second one more on emerging markets. I now would like to turn the attention to policy reactions. So I mentioned earlier in my presentation that there have been quite a lot of quick reactions by policymakers, and I kind of want to go a little bit more into detail into that. So if you look back in March, April, many of these emergency measures were swift and they were big. They didn't really care about the costs, and they did not always necessarily care about the proper targeting. It was more like survival mode. How do we protect the economy and the society at large? Fiscal policy measures, and here I'm talking more about more advanced countries. Furlough schemes, or Kurzarbeit in the German word for it, so where the government pays part of the workers' salaries, even if they cannot work. Direct support payments to small businesses or households, tax payment holidays, loan guarantees, even direct lending. On the monetary policy side, there was a reduction in interest rates, but that doesn't seem to have been kind of the major policy. It was more flooding the markets with liquidity to make sure financial markets continue to work, but even then also direct firm supports, be it through bonds purchase programs, or even in the case of the US, direct lending. What I'm going to talk about more in a moment is the regulatory policies. We had lots of capital liquidity relief. We had a delay in the Basel III implementation, the delay, at least in Europe, in the stress test from 2020 to 2021. But, and I'm going to come back to this in a moment, also restrictions on profit distributions. The result of this has been that there has actually been a kind of a reduction in corporate and households insolvencies because of these support measures. People, on a positive side, you could say, it avoids hysteresis. So it avoids that people lose their job, stay without nothing, without support, and basically also avoided an increase in unemployment. So we've seen a very small uptick in unemployment only, at least in the European market, and very different from the US market, as I showed you earlier. So it was really about throwing everything at the crisis, going for survival. The big question I'm going to come back to later at the very end is, by supporting the economy and society, by almost kind of some people arguing going into a state economy now, are we preventing the functioning of market forces? Are we preventing the Schumpeterian creative destruction where some businesses that will not be viable in the future are kept alive artificially, kind of creating zombies? Are we preventing the resource allocation that will be needed after the pandemic? So that's a question I'm going to come back at a later stage. Sorry. So this is a graph that I found in a very interesting World Bank publication just from a couple of weeks ago that looks at different financial sector measures that have been taken around the world. And as you can see, starting in March 2020, and then picking up very rapidly, lots of countries took quite a lot of measures. Among them, the ones that I mentioned here, in the monetary and in the monetary policy, but also regulatory policies. There is somewhat a correlation with the exposure to COVID-19, but also a correlation with what they call here policy stringency index, which I called earlier the kind of the stringency of the lockdown policies that I mentioned in my US-based paper. So where countries were more exposed to COVID-19, where governments reacted more powerfully with lockdown policies, to a certain extent, you also saw a more measures in the financial sector to ultimately support the real economy. Against the ideas of many of these financial sector policies was not to protect the financial sector per se, but actually to help the real economy to survive. So just to kind of come back on this theme, as I mentioned earlier, we saw a heavy drawdown of credit lines, an increase in credit demand, partly liquidity for firms that lost their revenue but had still their costs. Relationship lenders, and I'm going to come back to this also later, could actually still be very useful in this situation, because they know their clients and they know when the clients it has just a liquidity crisis or might be insolvent. And of course, banks, they have a very critical role in the transmission of monetary policy and of also the fiscal support measures, for example, credit guarantees, for example, in simply paying out direct support for households and small businesses. So just even as a purely transmission tool, banks have turned out to be very important during this current crisis. I just want to very briefly refer to credit guarantee schemes, because there are some questions that I would like to raise. Some of these were given out very freely, very liberally. The question, of course, are loans really what firms need at this moment? Or do they actually need grants? Are we actually pushing firms into over-indebtedness? Another question, and here the difference between Switzerland and the UK comes to mind. In Switzerland, there was a 100% coverage ratio, and it was fairly easy to get such a loan guarantee. So everybody basically got one. The UK had initially, at least, I think, a 10 or 20% skin in the game by the banks. So only 80% coverage ratio. That also means that banks were much more careful. So the immediate effect was not as positive, but maybe also it was more prudent. The question is, what is the exit plan from these credit guarantees? The word exit is going to come in my last part again of my presentation. How do we exit from all of these support measures? And again, might no longer be viable after the pandemic is, are we actually preventing capital reallocation? Again, so there's this very clear trade-off, which you could also actually frame into a sense of the Keynesian macroeconomic approach versus more the Schumpeterian neoclassical micro approach. Is that we just want to get a quick recovery, or do we actually want to have an efficient real sector coming out of the crisis? And it seems, of course, like a contradiction. It is a contradiction to a certain extent, but of course, different policies are useful for different points in time. And of course, ultimately, all of these support measures will ultimately have to be paid. There will be losses. The question is, who will bear the losses? So let me then now focus a bit more on the European banking side, the European bank regulator, and what they have done, because that is, of course, one of the areas where I've focused most on myself, including the policy process. What you saw in March, very quickly, lots of capital relief. The capital conservation buffer was released. National authority, where they could, reduce the countercyclical capital buffer to 0. The Pillar 2 guidance basically fell away. The Pillar 2 guidance under Basel III. There was also an easing on the provisioning rules under IFRS 9. And there was, as I mentioned earlier, the moratorium on further regulatory reform. So all of these basically with the aim to reduce the capital requirements and basically allow for banks to continue lending. Of course, on the background that we know that banks behave very procyclically. They have the immediate kind of instinct of reducing lending during a crisis. So these measures were clearly targeted at preventing this kind of reaction. Now, very specifically, this is on the calculation for the euro area and the measures of the ECB plus national authorities. As you can see, there was ultimately a, so I have to move my own person now. Yeah. there has been a overall reduction in 4.2 percentage points relative to risk-weighted assets, or almost 350 billion euro in capital relief that has been granted to banks in the spring of 2020. And ultimately, that's what it translates into is that the credit to the real economy increases by around 3%, or 70 to 90 billion euro in 1 year. Just these measures, and just kind of taking a very static approach by kind of saying, well, how much does typically lending increase if you reduce capital requirements by 1 percentage point, and then do a back of the envelope calculation of how much more credit there would be from this approach. Which again, it's a static approach. It doesn't say that banks are actually doing it. The good news is actually banks did do it. So similarly to what we saw in the US, there was a big increase in lending by banks in the euro area in 2020. You have these columns are the outstanding amount, and you can see the increase towards between January and August 2020, and the blue line that jumps around, that's the actual the monthly change in the volume, and you can see there's a huge spike, a huge increase in I think it's probably March or April of this year, in terms of more more lending to the real economy. Again, mostly to the private sector. Sorry, mostly to the corporate sector. So now one important discussion that has been had and very controversial among observers has been on the profit distribution, sometimes also just referred to as dividend distribution. So the European authorities, starting with the ECB, Bank of England, but then also the macroprudential authority, the ESRB, where I'm involved in, have been quite radical in their approach, in basically in March, May, asking financial institutions to stop distributing dividends and also stop share buybacks. Some including also asking them to reduce the variable remuneration to material risk takers, so the bonuses. So this was in the spring, and now just last week, actually, the second round with both the ECB, but then also the ESRB, kind of lifting the blanket ban, but still asking for constraint from banks, but also insurance companies in terms of distributing their profits. And again, that's very different, for example, from the US. The US ultimately allows, again, for buy share backs, which is the major tool of profit distribution in the US. Just no dividend payments, but share buybacks are being allowed. Now, you could argue, why is a different approach from the spring to the winter now? What we had in the spring, in March, April, in case you still remember it, it seems like a decade ago now, but we had something what can be referred to as the unknown unknown. So the uncertainty was enormous. Nobody had any idea how this would evolve, how long this crisis would take, and how big the losses would be. So basically, applying the handbrake was the only option that many regulators saw themselves available, applicable. Now in the winter, we kind of moved from the unknown unknown to known unknowns. So we kind of know how things are working out. We have kind of certain expectations, although of course with a high degree of uncertainty, with a large distribution about the performance of the economy next years. We kind of know what losses are there to be had, but of course there's still a very high degree of uncertainty. And ultimately that's the reason why both the ECB and the ESRB still have restrictions in place for distributions on profits. I'll just come to this more specifically. So on the one hand, why would we restrict banks from paying out profits to their shareholders, which ultimately intervenes into private property rights? It is a very strong instrument, actually. I mean, I think this should be understood. That there is not really any, number one, there's no legal basis actually for it. It's more like moral suasion, although there seems to be some kind of legal rule somewhere which hasn't been really applied yet. But it's something that is relatively new in the regulatory toolbox, and again, which is seen as quite radical by markets. Now, one reason, of course, what it's done is because earlier that NPLs and loan loss provisions haven't really gone up, at least in the US, but it's the same also for the Euro area and for Europe in general, is because of all of these support measures. Loan losses haven't had to be recognized quite yet. So this is still to come. So paying out profits now, of course, might result that later on banks have the losses appear on their balance sheet and might actually fail and missing the capital buffer that they would pay out to their shareholders. Well, generally, if you have this public support going through the banks, such as loan guarantees, why should shareholders benefit from that? And ultimately, kind of bringing this all together, shouldn't there be a coordinated timeline for exiting from the crisis, in the sense that exiting phase out of government support, exit strategy for the capital relief, and knowing what losses are out there on banks' balance sheet or what losses can we expect, which will not come before the 2021 stress test, that might actually also be kind of coordinating this with the lifting of any restrictions on the profit distribution might actually be very reasonable. However, there are also strong arguments on the other side I want to mention. So there is the problem that the EU is the region which is still strongest in terms of restricting profit distribution. And that might, of course, create a stigma vis-a-vis non-EU firms. And of course, can have a negative effect on EU banks' valuation. And might ultimately also, given the higher uncertainty for investors, ultimately result in investors being less likely to open up their purses once banks want to go back to the market, especially given that banks' shares are especially attractive for investors that rely on income rather than on growth. Now, also you could think that the losses, even if we kind of know by next summer how big they will be, they might not peak actually until 2022. And it's really a question whether we can maintain this kind of restrictions until then. There might also be a perverse effect. Banks are supposed to use these additional buffers and then the payout restrictions to lend more. However, if they think that they can just hold it back and then pay out later, they might not actually use that additional space they have, these additional buffers, to lend. So it's kind of a perverse effect. As you can see, there are quite a lot of arguments on both sides, including also of course, the limited legal base. But ultimately, and this comes back to a similar theme, if we think that market forces have to come back into action at some point, then of course we cannot restrict these profit distribution and therefore the property rights of private investors. So let me come to the last part of my presentation. So I've talked about the effect on banks, on emerging market firms, and I talked about policy reactions and the discussions around these reactions. And I want to kind of do a bit of a crystal ball approach in the final section. Not that economists like me are very good in predicting things, but there's something I think that are definitely on the horizon, on the agenda in 2021. So one thing that we certainly know is that the increase in lending will lead to over-leveraging of certain firms, while at the same time, some of these firms in certain sectors will no longer be viable. So especially firms that rely heavily on physical contact, think about restaurants, for example, cruise ships maybe, even airlines, they suffer heavy losses, and some of them might have to exit the market. How do you deal with that? Will the corporate insolvency systems, for example, even in European countries, will you be able to deal with a wave of corporate insolvencies? How do you decide between liquidation and restructuring? Now, one suggestion is that given that Europe, and again, this is mostly here in Europe, that Europe is heavily bank-based, maybe this process should be led by the banks themselves that are ultimately the major creditor of many of these companies. The question is, of course, what kind of incentives do you give banks in this process? At the same time, we also know there will be ultimately losses on banks' balance sheets. and eventually they will have to recognize them. And actually, eventually they should be forced to recognize them, because if not, then you get a similar situation like after the global financial crisis with zombie lending and with evergreening of loans and with zombie lending. How do you deal with these non-performing assets, these non-performing loans? The European Commission just recently came out with a proposal to kind of strengthen the markets in non-performing assets in the private markets, in non-performing assets in the European Union. But the question is, do we have to go a step further, and do we actually have to go for an asset management company, for a kind of a bad bank, such as suggested in several occasions by Andrea Nia, the former head of the EBA and the current head of the Single Supervisory Mechanism? And how do you deal beyond that? How do you deal with failing banks? In the EU, we have now the BRRD, so the new bank resolution framework. We have the banking union in the euro area. Is that sufficient for a systemic banking crisis? Is it sufficient if several banks face at the same time? Not that I'm predicting this, but of course it is a possibility. So that's definitely a question that policymakers have to ask themselves. And ultimately, the big question is also on the government side. It has been pushed back a little bit, partly due to this positive development that of the European Recovery Fund, kind of a push into sharing costs, the fiscal burden of the crisis across the euro area and across the EU. But ultimately, this question might still come back to haunt us. Right now, the approach is through monetary policy, having monetary policy rates at 0 or negative rates. But of course, this kind of might ultimately lead into fiscal dominance, and with the ECB not being able to raise their interest rates because of the debt burden or the additional debt burden this might impose on some of the member countries. So certainly for macroeconomists, an important point to keep in mind. Sorry. So I mean, again, I'm not predicting a banking crisis. I wouldn't like to do that. But there seems to be a situation that could result in another perfect storm, as we saw them in 2008. Although, of course, we know much more and regulators are much better prepared. We have low interest rates for quite some time, and we're now moving to what is called lower for longer. So we're going to have now negative interest rates probably in the euro area for, I don't know, for another 5 years, and we're going to have low interest rates for another decade or so. What implications does it have for the business model of some banks that rely heavily on intermediation, for example, in Germany? It is, of course, again, negative interest rates plus all of these capital relief is a perfect setting for more zombie lending, but also for kicking the can down the road because the costs are not there yet. I mentioned earlier the exit strategy, and I promised I would come back to the exit strategy. How do we design such an exit strategy for corporations to wean them off the loan guarantees from the additional lending, but also for banks? And with the loan guarantees, if they are called in, what will the banks have to do? Will the banks first have to pursue the borrowers for payment, which will not make them very popular and might also be very costly for them? Or can they just go to the government and ask for the payout? So ultimately, a lot of these losses will appear on governments' balance sheets, but some of them actually might first show up on banks' balance sheet. And then, of course, the other question is, what do we do with the banks, as I mentioned earlier? So there seems to be clearly a need for a coordinated approach across these different areas, and ideally also across, at least in Europe and the European Union, across different authorities in different countries. Now, is this time different? Well, if we are moving towards a banking crisis, it is actually, I would say, a very different banking crisis than from what we are used to, including in emerging markets like Turkey, because there is not this traditional overlending that we've seen in many previous crises, like a subprime crisis or many emerging markets crisis, where banks or financial institutions or financial markets just lend too much and become too risk aggressive. Here, there might be also overlending, but it's more because of the crisis, because the denominator has gone down, the sales, the assets. So it's more an over-leveraging problem per se. The other big difference, of course, is we know this is coming. So we can actually prepare ourselves. So unlike in 2008, when the European policymakers woke up, or were woken up in the middle of the night, being told that there's a bank about to be broken, and they didn't know what to do because they didn't have bank resolution frameworks. This time there's more of a head, a kind of an advance notice, and there are also better frameworks in place. Again, for the euro area though, the banking union, again, I can come back to this later on, the banking union is not quite perfect, it's not complete, and therefore there's still some gaps there that would have to be filled first. Again, lots of different dimensions, and I'm kind of just repeating myself, you know, I'm sorry. There's a potential corporate insolvency wave, especially in certain sectors, which again, might actually also depress asset prices further, right? So if you have lots of restaurants going broke at the same time, the value of the underlying collateral, for example, is going to reduce further. You have non-performing assets on banks' balance sheets. Are asset management companies really enough? Are the markets for non-performing assets really enough? And ultimately, what do you do if we have failing banks? Is the current bank resolution framework really adequate for a systemic banking crisis? Because so far it has been only used for idiosyncratic failures. The big question, and that's not different, the big question is always in any crisis, how do you allocate the losses? Initially, and very appropriate so, it's the government who took on all the risk, all the uncertainty, because the government is ultimately the best player to take on the risk during such a crisis. But ultimately, how is this going to be financed? We know that, of course, with monetary policy at zero, there is lots of space, but there's also certain limits. Is it going to be wealth holders that are being asked to come up? Is it future generation? So how are these losses being distributed over time? That's a much broader question beyond the financial sector. It's a much more societal questions where not just economists, but also political scientists, historians, and so should chime in. I'm almost done. Very briefly on the medium to long term, because there is of course, we had before the COVID-19 came along, we had already discussion on the future of banking. How will banks react to the low interest rates, which undermines their bank business? How have they reacted to the tightening of regulatory requirements? And how especially will they react to digitalization and the rise of both fintech and big tech? And of course, if anything comes out of this crisis is that the value of technology in financial service provision is even stronger now than it used to be before. Nobody really wants to handle cash anymore. We all want to pay via our mobile phones or on the internet, which gives again a benefit to fintech companies, but also the big tech companies. So big tech, the platform companies, Facebook, Google, and so on, Tencent in China, because they will also, of course, come very well out of this crisis with big cash piles. Now, only one thing I want to mention in favor of banks. Relationship lending, again, has shown to be very beneficial, very useful, and ultimately that might also underpin the franchise value of banks going forward, even though their margins are being squeezed from all sides. Sorry, let me just actually give one more slide. I take 2 or 3 more minutes, if I may. I've talked about, I kind of went back between US emerging markets and Europe, but let me just make a few remarks on developing countries more generally. Now, again, and here I'm I've done lots of work in Africa, for example, some work also in Latin America. So one thing I've always observed is that banks in emerging markets, in developing economies, are often more capitalized. They actually have stronger buffers than in advanced countries. On the other side, they also have much less diversified portfolios. They're much more exposed, for example, to natural resource sectors. They might be less relevant for the economy at large, given that many firms do not have access to financial systems. But of course, this can even be an advantage here, a similar advantage as during the global financial crisis. And here again, I would also be actually interested to hear the perspective from Turkey, because I know there was a bit of a consumer credit boom in Turkey going on. Some countries with consumer credit boom might actually be in for a bit of a shock during the crisis. Again, this is a simple off-cuff prediction, which I don't have any data for, but I'm kind of, my hunch tells me that. There will, of course, there's a whole debate which I can't touch upon on sovereign default risk, especially some countries in Africa, for example, an increasing role of Chinese debt, which has to be addressed. One positive thing coming back to the functioning of the financial sector is that the change, almost the revolution in finance in many developing markets in terms of the role of mobile money and mobile phones enables a much better risk sharing across families, across regions in developing economies, but actually also, and there we've seen some example, for a much easier, speedier, and more effective push out of government support programs. So let me finish and kind of try to summarize. There's so much more to say. So as I mentioned earlier, the crisis did not start in the financial sector, but the financial sector will be critical, for better or worse, on how this crisis will play out. In the worst case scenario, in some parts of the world, this might turn into a financial crisis. And I really hope that we can prevent that. The initial reaction, on the other hand, it can be important for the recovery process, if handled correctly. The initial reaction, policy reaction, were all very welcome, and I have nothing bad to say about them. The hard work is still ahead. How to allocate the losses, how to restart the economy, how to exit from the support programs. And there will be some very hard choices coming up in terms of bailouts. I mean, real economy, real companies, real sector companies have been partly bailed out. What about banks? Would we really have to bail them out again? What about state aid for firms with headquarters in tax havens? Big question beyond my talk here. What about transfer payments across countries? A big issue, of course, in Europe. We hardly address this now with the European Recovery Fund, but it might be a broader discussion also for developing countries. Of course, the question on taxation, is that the moment to actually go back to wealth taxation, wealth tax? Again, beyond my own area of expertise, but certainly an important question. Ultimately, so we academics, we technocrats, can give a lot of responses to these questions. I think it's very, very important that all of these decisions are being taken by politicians, not by central bank governors, not by regulators, but by democratically elected and accountable politicians, because ultimately these are very big decisions where you have to take the people with you to avoid another wave of populism coming our way in a few years. Thank you very much.
Thank you. Thank you a lot, actually. It was very, very nice, very well organized and excellent conversation. And we have various questions starting from Professor Erzan's, actually, the question that, if I may, I can direct to you. When the pandemic is at its peak, the Fed has allowed the banks to resume share buybacks based on stress test results. Do you think the banks have done enough during the pandemic? And do you think the Fed decision is timely?
Yes, well, thank you for this. So this goes a bit to the question, to the issue that I discussed on the profit distribution. There are different, when I discussed this with my former PhD supervisor actually in the US, he reminded me that the approach in the US and in Europe is a very different one. In the US, there's a general belief in markets. So the markets will take care of everything. In Europe, our first reaction is what can regulators, what can governments actually do? So again, the reactions here in Europe has been a very different one from the US. The US, again, the Fed has allowed the banks to start share buybacks. In the EU, it's very limited, if at all. The first, the main line is still do not distribute profits. And if you do it extremely carefully, subject to a certain cap. And of course, subject to what your supervisor basically tells you to do. Now, it might, of course, also be that the situation in the US is different from Europe. In Europe, there has been also more, as I understand it, more support measures and more losses basically showing up at a later stage than maybe in the US. But again, so I don't want to give, and apologize, I don't want to give a clear answer to this question, but I basically want to say is that this is this trade-off between, do we want to allow the market to play its role on the one hand, how much can the government do? How much should the government intervene? And in this kind of trade-off, Europeans have taken a stronger view towards the government. The US has taken a stronger view towards the market.
Thank you. We might have another question from Afshin Shahin. Do banking stocks prices reflect profitability of the banking sector in emerging markets following COVID-19?
Okay, that I wouldn't know. Sorry, I can't really give you an answer to that. Especially, I don't know how much the emerging. I'm not sure how much these stocks are being pushed up by support measures or not. So I'm not quite sure I can give you a clear response to that. What I can tell you more for the advanced countries, I mean, we've seen a big drop in bank stock prices, even more so than for real sector companies. So bank stock have been more negatively affected, and that kind of reflects, I guess, the loan losses that are to be expected in the future. So again, I wouldn't really know what for emerging markets, but for advanced countries, I think that to a certain extent they do reflect the low profitability, but also the loan losses that are still to come in our countries.
There is another one from Ömer. He says that he asked that, what do you think the future of emerging markets and Turkey's banking sectors for 5 years after COVID-19? So that's a kind of another crystal ball about this one.
Yeah, I mean, I think, look, define banking, right? So I mean, banking will always be there. I mean, some people call bankers the second oldest profession in the world. Apologies for this bad joke. So the financial services are important and will always be there. The question is, of course, who will actually perform them and how efficient are they being performed? So there will, I mean, again, I would actually also like to hear your view on that. There might be quite some stress coming also for banking sectors in many emerging markets, including in Turkey's, related to the losses, for example, on consumer credit, but also partly on the corporate credit. This would imply a certain restructuring that might have to involve some recapitalization, that might have to involve some government support. However, I think given the critical need for a functioning banking sector, I think if the right policy choices are being taken, then yes, the banking sector will come back and will hopefully support the real economy in 5 years. Now, again, I've started in my response with saying define banking. There might be going forward a stronger role for non-bank financial providers, such as fintech companies, such as big tech companies, right? I mean, we've seen this, for example, in China, an enormous role for big tech providers. We see an increasing role for fintech providers, lending platforms. So they might actually take on a certain larger role following this crisis and also following maybe a heavier regulation of banks. This, of course, and again, this brings me a bit to another topic now, this might also require certain additional regulatory responses to make sure that the risk is not being transferred from the regulated banking system into a non-regulated, non-banking system.
I'm using my monopoly power and I'll ask my question. What do you think that all these regulations after the crisis, like Basel III and all that, was helpful in at least in recovering in the COVID-19? Would it be worse if we were not to raise all these capital ratios and liquidity ratios and all that?
Yes, thank you for that. I mean, I think it's a relatively easy answer. I think yes, absolutely. I mean, we've had a lot of discussions among economists over the last 10 years whether capital requirements should increase even further. So many say, including myself, are saying yes, they should have increased even further. But even so, having said that, capital buffers are so much higher now than they were in 2008-9. I don't know the answer. I don't know the numbers out of my head, but I think we're talking at least double right now. So I think that by itself gave a lot of space for additional lending and for this capital relief that we observed. Now, having said this, one of the important innovations after the Basel III, or actually after 2008, I think it actually came a little bit earlier than Basel III, is the so-called counter-cyclical capital buffer. which was supposed to be built up during the good times and then reduced during the bad times. Now, actually, to my own surprise, when I looked into this in March, I found that many European countries, especially in the euro area, didn't have any counter-cyclical capital buffer. So what I'm saying is that it should have been, the counter-cyclical capital buffer should have been built up even more before the current crisis, and that would have been even more helpful. But again, in general, I would say yes, the Basel III reforms have been very positive.
Thank you. Thank you. Any more questions from the floor or screens?
Yeah. Okay.
Okay. If no more questions, then
see here, cost of insolvency varies across jurisdictions. One size may not fill out when insolvency starts bringing. That's absolutely right. I agree with that. I mean, so especially again, if I talk purely from the viewpoint of the European Union, where there's often a tendency to go for EU-wide solutions, insolvency law is national. So you can't really do this purely on a supranational or on a EU-wide national. I mean, you get to a European insolvency. I'm not even sure whether I'm young enough to actually see this coming into an effect. So it is the insolvency procedure itself and the way corporate insolvency have to be resolved has to be at a national level. The question is, can there be any push? Again, it has to be implemented on the national level to make it more efficient on a short-term notice after the COVID-19 crisis. So there have been examples, and it's not really exactly my area of expertise, but there have been examples in previous crises where kind of wide waves of corporate insolvency have been addressed through special programs, kind of out-of-courts procedures, maybe bank-led procedures that dealt with these insolvencies and basically prevented that these insolvencies would be tied up in the court system for years, if not decades to come. So I think an approach, an effective and efficient approach is needed. It definitely has to be implemented on the national level.
Thank you. Thank you. Any more questions, comments? If not more, I guess can stop here. Thanks a lot for very nice and very encouraging questions and comments and observations. We really very helpful for the Turkish banking system as well to look forward. And hopefully next time you have more Turkish data and everything, so that makes you so.
And hopefully next time we meet in Istanbul.
We wish so. We wish so. Okay.
Okay. Well, thank you very much for the great questions. Thank you. Bye.
Bye.
Thank you. Bye.
Thank you.
Thank you.
Thanks.
Thank you.
İyi akşamlar.
Çok teşekkürler. Çok sağ olun.
Yayını kapatıyorum. Herkese çok teşekkürler. İyi akşamlar.